CN Energy Group Inc. NASDAQ. CNEY Institutional Equity Due Diligence Report. Date: September 10, 2025. Executive Summary. Investment Thesis. CNEY reports around $51 million in trailing 12-month revenue, but continues to suffer losses of more than $14 million. The company presents itself as a green energy and specialty materials player, producing wood-activated carbon and biomass electricity, but the fundamentals point to chronic unprofitability. Rating: Sell. Target price: $0, $1. No realistic upside. Current trading price of $2.43 has already been inflated by a 1-4-25 reverse split. Top catalysts: sustainability marketing, potential government subsidies, or an unlikely merger. Key risks: persistent net losses, negligible cash position, repeated going concern warnings, regulatory opacity due to Chinese operating subsidiaries, and possible delisting. Company overview and business model. Founded in 2018, CN Energy Group Inc. is a British Virgin Islands holding company with Chinese subsidiaries. Its main operations involve manufacturing wood-activated carbon for environmental, food, pharmaceutical, and water treatment uses. The firm also dabbles in biomass electricity generation and forestry management. Revenue derives from commodity sales of carbon products and raw materials, with no recurring revenue or premium brand positioning, industry and market position. Activated carbon is a small niche within the global specialty chemicals market. Demand is linked to industrial purification, water treatment, and environmental compliance. The sector is moderately competitive, but large established producers dominate. CN Energy is a micro-cap with no brand recognition, limited scale, and minimal competitive standing. Revenue streams and segment analysis. Reported trailing 12-month revenue is $50.96 million. No breakdown by geography, product, or customer base is disclosed. Customer concentration and contract visibility are unclear, suggesting weak transparency. Competitive advantages and moat. The company has no discernible moat. No proprietary technology, intellectual property, or cost leadership. Its products are undifferentiated commodities, making it vulnerable to pricing pressure and substitution. Scalability and growth drivers. Management has referenced potential expansion into biomass power and forestry services. But these remain aspirational. Cash burn and lack of funding sources limit scalability, and M&A prospects are unrealistic given financial weakness. Financial statement analysis. Income statement. TTM. Revenue: $50.96 million. Gross profit: $0.29 million. Operating income: $10.68 million. Net income: $14.04 million. EPS: $103.27 post-split. Margins: gross minus 0.57%. Operating minus 20.96%. Net minus 27.55%. Balance sheet. Cash: $317,323. Total debt: $0. Total equity: $96.91 million. Total assets: $98.36 million. Liabilities: $1.45 million. Debt to equity ratio: 0%. Cash flow: operating cash flow: $2.37 million. Free cash flow: $2.37 million. FCF per share: 42 cents overall. Shrinking cash base. Negative margins and repeated operating losses raise material doubt about sustainability. Valuation. DCF analysis: not meaningful due to negative earnings and lack of forward guidance. Multiples. PE: not applicable. Losses. EBITDA: negative. B ratios: meaningless without consistent profitability. Scenarios: bear. Bankruptcy or delisting gives $0 base. Survival as a penny stock gives $1, $2 bull. Rare turnaround or acquisition gives $5, highly unlikely. TAM, SAM, SOM, and growth potential. Activated carbon industry has modest global growth, driven by environmental regulations and water treatment needs. However, CN Energy controls a negligible share and lacks resources to expand meaningfully. Peer comparison and competitor landscape. Comparable firms in activated carbon and biomass energy have significantly greater scale, stronger balance sheets, and diversified revenue bases. CNEY is not competitive relative to peers. Management and governance. The company has a dual-class structure where Class B shares carry 50x the voting rights of Class A. This entrenches insider control, leaving minority shareholders with little influence. Its board independence and governance quality appear weak. Auditor reports include going concern warnings, risk assessment, financial risk, negative free cash flow, almost no liquidity, no debt cushion. Market risk, a liquid microcap stock, reverse split history, limited investor following. Regulatory and geopolitical risk, offshore structure with operations in China, subject to regulatory crackdowns and potential USD listing. Execution risk, no track record of scaling operations or sustaining profitability. Shareholder returns, no dividend history, no buybacks. Shareholder yield is sharply negative due to dilution from equity raises. Capital allocation practices reflect survival rather than growth. Insider and institutional activity. Institutional interest is negligible. Insider holdings dominate due to dual-class share control. Limited trading activity confirms lack of market confidence. Debt and liquidity. The company has no outstanding debt, but also no meaningful cash reserves. Liquidity risk is extreme. Without immediate capital infusion, operations are at risk of insolvency. Short interest and options market. Short interest is minimal at about 1% of outstanding shares, suggesting that traders see little to gain from shorting such a low liquidity microcap. Options market activity is negligible. Technical analysis. Share price $2.43 as of September 10, 2025. Short-term indicators mixed. Long-term trend bearish following reverse split. Support levels weak near $2. Resistance $4, $5, unlikely to be tested without major news. Ratings and consensus, no active analyst coverage, no price targets, and no institutional research coverage. Legal, regulatory, and ESG. The company has received NASDAQ non-compliance notifications for delayed filings. Auditor reports highlight substantial doubt about its ability to continue as a going concern. ESG metrics are not published. Forestry activity is nominal and not credible for sustainability scoring. Investment outlook recommendation: strong sell. CNEY's business model is unsustainable. Financial health precarious, and governance unfavorable to minority investors. Delisting or collapse is a real possibility. Trigger events: filing of overdue financials or auditor clearance. Strategic investment unlikely. Regulatory relief on China-based listing standards. Appendix key figures: revenue $50.96 million TTM, net loss $14.04 million cash, $317,323, equity $96.91 million, debt $0 gross margin, minus 0.57% operating margin, minus 20.96%, net margin, minus 27.55%. This company is essentially a financial zombie. Small, cash-starved, and clinging to a NASDAQ listing through reverse splits and regulatory extensions. The only rational stance is to avoid or exit.